What will precipitate the next global financial crisis? Will it be as bad as the last one, or could it be many, many times worse? Could it even have the power to bring the entire world monetary system crashing down around us? As you can see, it's a pretty gloomy day here in Puerto Rico, and that's because a tropical storm just passed through, but that is nothing compared to the economic storm that's coming. Going to the goldsilver.com news page, I try to put these videos together, and as I'm doing it, if I go back and glance at the news, there's another story that's added to the story that I'm trying to tell, where I want to try and connect some dots for you. So here we've got 30 million Americans didn't have enough to eat last week. What is hyperinflation and why should you care? The U.S. dollar is losing its clout as the world's reserve currency. It's time to abandon U.S. dollar hegemony, and these two articles relate. Gold surges and adds $3 billion to just three families' fortunes. 434 tons of gold were purchased in the second quarter. China says U.S. is fueling a new Cold War due to the presidential election. $158 billion in collateralized loan obligations bet is putting the insurance industry at risk. And in this chart, you'll see that the insurance companies own about a third of all of these. Ravaged by Mexico's GDP falls a record 17.3% in the second quarter. Plunges German economy into a record recession. U.S. GDP, I'm going to get to this story in a moment, crashes by a record 32.9%. That is basically 1/3. That is 33%. Worse than the Great Depression. Continuing jobless claims spike as almost 50% of lost jobs may be gone permanently. This is a disaster. Fed plans for the worst as it waits for Congress to act. Over 62 million people had no pay last week. Fed chief says surge starting to dent U.S. economic recovery. I'm sorry I'm laughing, but it's just unbelievable that the people that are running things are so far behind the curve. They're saying that this is the coronavirus surge is starting to put a dent in the recovery and we aren't done crashing. There's no big recovery coming. In an unprecedented move, Congress proposes taxpayer-funded bailout of $550 billion this is commercial mortgage-backed securities. So that's all of the commercial properties. U.S. small businesses face mass closures without more pandemic aid. U.S. Treasury makes a $10 billion loan to the Postal Service. U.S. renters owe $21.5 billion in back rent. So let's get into some of these stories. In an unprecedented move, Congress proposes taxpayer-funded bailout of the commercial mortgage-backed security industry. So we had a taxpayer-backed fund out of a taxpayer-funded bailout of the mortgage-backed security industry in 2008, 2009, when mortgage-backed securities melted down. Now it's commercial mortgage-backed securities. And in this chart here, what you see is this huge climb from $2 trillion in delinquent, percentage of mortgage-backed securities marked as 30 days plus. So commercial mortgage-backed securities plus days delinquent. And it was only 2% back in February. Now it's 10%. That is a huge change. And there's Representative Taylor, that's him, and and he's a Republican, and then Lawson, a Democrat from Florida, are sponsoring this bill. Under it, this is $550 billion in distressed securities, and that's going to come from the $454 billion pot that was set aside for distressed businesses in the earlier stimulus bill. So basically, it'll suck, if there's anything left there, it'll suck all of that up. But the best sentence here is what was left completely unsaid is that the capital infusion will come from, drumroll please, the idiot taxpayers who won't even understand what's going on. And this is true, I'm sorry to say. But industry, all of these commercial mortgage-backed securities are held, roughly 80% of them are held by a handful of funds who will be the ultimate beneficiaries of this unprecedented bailout. Funds which have spent a lot of currency lobbying Messrs. Taylor and Lawson. So they've spent a lot of money romancing these guys that have introduced a bill to save them, and it's all going to be paid for by us. 30% of Americans missed their housing payments in June. So that's 30% of Americans' housing. That would be both rents and mortgages. U.S. renters owe $21.5 billion in back rent. The feared jumbo mortgage debacle is here, thanks to the and ready to pound the housing market. Now, as you scroll down in this article, there's some numbers in here that are pretty frightening. According to data provided by Black Knight Financial Services, 46% of borrowers who obtained a forbearance actually made a mortgage payment in April. So forbearance means they got the bank to forgive missing a payment or two. So the bank is modifying the loan. 46% of the borrowers that asked for forbearance were actually able to not use it. They made their payment in April, but that dropped to only 22% that were able to make their payment in May and 15% in June. So these loans are going bad. They're delinquent now. According to Black Knight, 11.8, let's just say 12% of all jumbo loans are in forbearance as of June 16th. And so we're talking about, only 15% of that 46%. So this is close to half. And so let's say that that's 40%. So it's 40% of the 12%, but you're still talking about a lot of loans that are currently going bad. And the 42% of their customers who requested forbearance are self-employed. Moving on further down the page, what we see is that in October, he had focused on the growing problem of millions of Americans that have, with modified mortgages, that have re-defaulted. And he explained that most of the residential mortgage loans held by large banks are jumbo mortgages. Unlike smaller loans that were securitized and sold off to investors, jumbo loans are too big to be guaranteed by Fannie Mae or Freddie Mac. So this is basically wealthier people. And they were kept in the bank's portfolios. And that is 95% of the jumbo loans remain on the bank's balance sheets. So this is part of what is going to precipitate a major banking crisis. And this may not be bailed out by the government. It might be bailed in by the depositors of the banks, because this isn't Fannie Mae and Freddie Mac, which was the mortgage-backed securities that went bad last go-around. This is the jumbo loans that are on the bank's balance sheets. And so when the banks get in trouble, it's going to be a combination of bailouts and bail-ins this time. And so moving on, the may cause 40 million Americans to lose their homes. And this is a family that couldn't make their payments. And this guy he claims to have applied for more than 400 jobs over the past several months and cannot find a job, 400 of them. And they were evicted, and they are now living in a shelter. And then this chart was in that article, and it's showing the number of people facing eviction, and this is renters. The chart is of renters. unable to pay their rent and at risk of eviction. And it's of the share of the total renter households. West Virginia is close to 60% and 58%, 55%. Florida at 51%. And even the very best, the lowest percentage in here is Vermont at 22%. So everything, Washington 28, California 27, everything is, the national average is over a third, I would say, just looking at this chart. So nearly half of Americans are considering selling their home as crushes finances. And 47% of homeowners have explored alternatives ways of making money. 2/3 of the respondents stated that they've got side projects. 53% said they've sold valuables to supplement income. So you've got nearly half of Americans considering selling their home. To whom do they sell? How many people are actually looking to buy a home at any given moment? Do you think it's 1% of the population? 0.5%? 2%? 3% at the most? How many people are actively shopping for a home right now as a percentage of the entire population? My guess is it's like probably 1%, possibly even less. Who knows? But I know it can't be very large. And so half of Americans are going to try and sell their home to that 1% of Americans. This is just not going to work. I'm sorry. I shouldn't laugh at this. This is really depressing and tragic. But it just shows you that you really have to prepare for something here. This is going to be bad, what's coming at us, and we have to be ready for it. U.S. GDP contracted by a record 32.9% in the second quarter. And so 32.9, that is 33%. It's a third. And in here, there's a couple of great charts, and I'm just going to go right to the charts. The annualized GDP, this is worse than the Great Depression. There's nothing that has ever happened like this. 32.9% in a single quarter, and then to look at that in context, this goes back to the end of World War II. And so in 1958, there was a quarter that was a 10% contraction. But then look at the bounce back that we have. Almost 10% expansion back there. It was an expansion rate of like 6 or 7 or 8% when you average all of these out. And now we've got expansions that are like 2, 3, 4%. So if you could draw a trend line across this, it's this descending trend line. And then you've got this. So they had a contraction that was less than a third of what we've just experienced. And then this big, huge bounce back. We're not going to see that bounce back. I'm sorry. This is the next chart in it, and it's personal consumption quarter over quarter. This is important, quarter over quarter. So they're using the previous quarter as the benchmark. So this isn't the same as the last chart. And so here you have to look. This was back in the 50s, in 51 and 2, you had a couple of pullbacks, but it's coming off of this quarter as a benchmark. So it's really not that bad. This is coming off of this quarter. So to get a total contraction for the year, you have to stack them on top of each other. And that would push this way off the bottom of the chart. Now, this is personal consumption. On your personal consumption, if you've got to cut back because you're scared or you feel that you can't afford things anymore, what do you cut back on? You cut back on things like, well, I'm not going to upgrade to the latest cell phone this year. Oh, I'm not going to buy a big screen TV. Basically, what you cut back on is not the things that you need. This is the personal consumption index, and the way that the allocations of personal consumption: food and beverage, 17%, the biggies; housing, 32.9, so 33%. A third of what we spend is on housing. So this is something that you can't give up. You're sort of fixed there. You have to eat. The next biggie is transportation. Everything else are the things that we can sort of cut back on. So the first things you cut back on are basically the things like the cell phones and the big screen TVs, the things that we buy from China, which brings me to the end of this section. This is a look inside the $52 trillion bubble that has hijacked China's economy. This is the greatest bubble on Earth. And back in 2013, I went to China and I filmed in these ghost cities that they have, where you've got miles of these giant skyscrapers and huge apartment buildings. And so they build these ghost cities expecting them to sell in the future. And what happens is China has had this mandated real estate bubble because it was all state housing before. You would get assigned to particular housing. And in 1998 or 9, they stopped that and they started selling homes. And now it's the greatest bubble on Earth as real estate as a percentage of household wealth. So real estate as a percentage of household wealth in the United States, it's less than 28%. In China, it's almost 75%. So this is enormous, and the effect on China. Now remember, everything has a little bit of a delay. We've just stopped buying a lot of stuff from China, so the amount of trade, the stuff that we're buying, has really collapsed. It's going to take a little while to work that through. You know, it's a chain reaction. It takes a little while. But the U.S. housing, at its peak of the U.S. property boom, about $900 billion per year was being invested in residential real estate. In the 12 months ending June, about $1.4 trillion was invested in Chinese housing. The total value of Chinese homes and developers' inventory hit $52 trillion in 2019, according to Goldman Sachs, twice the size of the U.S. residential housing market and outstripping even the U.S. bond market. In fact, the entire world bond market is $85 trillion, and at its trajectory, this is projected to eclipse that in just a few years. 288 apartments in Shenzhen were sold online in less than 8 minutes recently. This is just a bubble waiting to burst, and what's going to precipitate it is all of the disasters, this set of dominoes that I just showed you that's happening in the United States, flooding over into the reduction in trade that's going to pop the China. So this is going to be a global financial disaster, many, many times worse than the. So the leverage ratio is at the household leverage ratio, 57.7%. That is huge. And down here we have the ticking time bomb, and this shows the China's home vacancy rate overshadows all other major economies: U.S., Taiwan, Japan, Hong Kong. The vacancies have increased. According to the Wall Street Journal, China's household financial survey shows that there are now 65 million empty units. There are 330 million people that live in the United States, but that's not households. Households is it's more than 2 point something people or 3 point something people. So you're only talking 120 million households, or maybe 150, somewhere between 100 and 150. There could be as many empty units in China as half of all the housing units that exist in the United States. That is how big this bubble is. And the return on rents, the yield, so this is the difference between the mortgage and what you're making on renting the property, has fallen to 2%, which means that once this bubble pops, they're all going to go backwards on these loans, and the value of the home will be less than what they owe on the home and what the income is from the home, and they're going to have to unload these things, and their real estate will crash as well. Now, a state council decision back in 1998 abandoned the country's system of employer-allocated housing. And so the state owned the housing. Employers could designate, you live here, you live there. And home ownership took off. And this is the growth in mortgage debt going from 2008, not from 1998, but back from 2008, from $3 trillion to the September of 2018 at just under 20. So by the end of 2018, this way exceeded 25 trillion. So the growth has been astounding. And it was 2013 when I went there and filmed and saw this massive bubble, and it's a government mandated bubble. The government created this bubble by, they owned the land. They would give this land or sell it cheap to developers. They would level it, build these new ghost cities, and sell them off. And all of these, the middle class bought them up as investments, hoping they would be filled. And that has worked. A ghost city takes a few years, several years, but eventually it does get filled. But they keep on building more of them. And now the average home price across China has reached 9.3 times the average income. And that's compared with San Francisco, the biggest bubble in the United States, at 8.4 times. And so this is a disaster waiting to happen. I know that it's going to start unraveling sometime soon. There's going to be massive currency creation coming to the aid of this. And what they don't understand is that ultimately it won't work. What it means is a collapse in the global monetary system. That's what it means. If you got anything from this, please like it and share it with everybody you can. Hit the subscribe button and give us a thumbs up. Thank you very much for watching. We'll see you next time.